The global economic landscape is shifting dramatically. Unprecedented levels of government debt and deficit spending are raising serious questions about the future of traditional currencies. This isn't just abstract economic theory, it has tangible implications for investors and the financial system. Now, a major voice from the heart of the crypto industry, Coinbase CEO Brian Armstrong, is issuing a stark warning. He suggests that the escalating US debt crisis could potentially force a fundamental change in the global monetary order, positioning Bitcoin as a potential successor to the dollar's reserve currency status. This isn't hyperbole from a crypto maximalist. It's a strategic observation from a key player in the financial technology sector. Armstrong's thesis, shared at the recent State of Crypto Summit, provides a compelling framework for understanding the intersection of macroeconomics and digital assets. For those paying attention, these signals are critical. Understanding this perspective puts you ahead of the curve, offering insights into potential future market dynamics that many are still overlooking. This analysis is particularly relevant for crypto investors, tech enthusiasts, finance professionals, and economic analysts tracking global trends. Stay tuned as we unpack Armstrong's argument and explore the data supporting this potentially transformative scenario. Hit like, share this video with your network, and subscribe to CryptoPulse. We're here to decode the complex forces shaping the future of finance and technology. Crypto assets are considered high-risk investments. They are not regulated within the United Kingdom, meaning there is no consumer protection available. You should be prepared to lose all the money you invest in crypto assets. This content is provided for informational purposes only and does not constitute financial advice. Before making any investment decisions, always conduct your own thorough research and consider consulting with a qualified financial advisor. A fundamental challenge facing the global economy is the relentless increase in government debt. Fiscal policies in many developed nations, particularly the United States, have led to spending far exceeding revenue for prolonged periods. This creates a growing national debt burden. The U.S. national debt has now surpassed $34 trillion and continues to climb rapidly. This figure represents the cumulative total of past government deficits. The sheer scale of this debt raises concerns about its sustainability and the government's ability to service it in the future. Globally, the situation is similarly challenging. Many countries are grappling with high debt-to-GDP ratios, exacerbated by recent economic stimulus measures and demographic shifts. This widespread fiscal pressure erodes confidence in the long-term stability of fiat currencies. Brian Armstrong highlights this unsustainable trajectory as a key driver for potential systemic change. He argues that as governments lose control over their fiscal situations, the perceived reliability and value of their currencies diminish. This economic reality is not confined to academic papers. It has real-world consequences for asset valuation and capital flows. The increasing debt load requires governments to issue more bonds, increasing the supply of government securities. This can put upward pressure on interest rates, making it more expensive to borrow for both governments and the private sector. It also raises the risk of inflation if central banks resort to printing money to finance the debt. This cycle of increasing debt and potential currency devaluation creates a compelling backdrop for alternative assets. Investors and institutions begin searching for stores of value that are not subject to the same inflationary pressures or government control. This is where assets with fixed supply, like Bitcoin, enter the conversation. The historical record shows that excessive debt and currency debasement often go hand in hand. When governments print money to cover their obligations, the purchasing power of that currency declines. This process, if unchecked, can lead to hyperinflation and economic instability. Understanding this macroeconomic context is crucial for finance professionals and economic analysts. It provides the why behind the growing interest in assets outside the traditional fiat system. The debt spiral isn't just a number, it's a fundamental challenge to the existing financial order. Brian Armstrong's remarks at the Coinbase Summit were direct and provocative. He stated, "If the US doesn't fix its debt situation, Bitcoin may have to become the world's reserve currency." This isn't a casual comment, it's a strategic forecast based on observed economic trends and historical precedents. The concept of a reserve currency refers to a currency widely held by central banks and used in international trade and finance. The US dollar has held this dominant position for decades, providing significant economic advantages to the United States. However, this status is not immutable. History provides numerous examples of reserve currency shifts. the British pound sterling held the dominant position before the US dollar. These transitions often occur during periods of significant economic upheaval, war, or when the dominant power's fiscal stability is questioned. Armstrong's thesis posits that the current level of US debt and deficit spending is eroding the fundamental trust required for the dollar to maintain its global reserve status indefinitely. As confidence wanes, nations and institutions may seek a more stable, apolitical alternative for settling international transactions and storing value. Unlike fiat currencies, which can be printed at will by central banks, Bitcoin has a mathematically fixed supply cap of 21 million coins. This inherent scarcity is a core tenet of its value proposition, particularly in an environment where fiat currencies are subject to inflationary pressures driven by government spending and monetary policy. For economic analysts, this presents a fascinating case study. Could a decentralized, digital asset truly fulfill the complex roles of a global reserve currency? It would require significant technological infrastructure, regulatory clarity, and widespread adoption by central banks and international bodies. Armstrong's prediction is not about an immediate overnight flip. It suggests a potential long-term trajectory if current fiscal trends persist. The increasing debt burden acts as a slow, persistent pressure point on the existing monetary system, potentially paving the way for alternatives. The debate around Bitcoin's potential as a reserve asset is gaining traction in financial circles. It moves beyond speculative trading and into the realm of macroeconomic strategy and long-term financial planning. This is why finance professionals are increasingly analyzing Bitcoin's properties alongside traditional assets. The historical pattern of currency devaluation following excessive printing is a critical piece of Armstrong's argument. By highlighting this historical correlation, he frames the current situation not as unprecedented, but as a recurring theme in monetary history, with Bitcoin potentially offering a novel solution. Brian Armstrong's suggestion that aiming for at least 0.1 BTC could be a significant position is rooted in the concept of scarcity relative to potential future adoption. If Bitcoin were to become a global monetary base layer, the total supply of 21 million coins would be distributed among billions of people and countless institutions. Consider the math: 21 million Bitcoins divided among a global population of over 8 billion people. If even a fraction of the world's wealth or population were to hold Bitcoin, owning a full Bitcoin would be exceptionally rare. Owning 0.1 BTC, or 10 million Satoshis, would represent a substantial percentage of the total supply per capita. This perspective resonates strongly with crypto investors, who understand the principle of fixed supply. Unlike gold, which can be mined further, or fiat currency, which can be printed infinitely, Bitcoin's supply schedule is predetermined and transparent. This predictable scarcity is a core part of its appeal as a store of value. For tech enthusiasts, the underlying technology enforcing this scarcity is fascinating. The decentralized nature of the Bitcoin network and its consensus mechanism ensure that no single entity can arbitrarily increase the supply. This technological guarantee is fundamental to its value proposition. Finance professionals often analyze asset scarcity in relation to demand when determining potential future value. In Bitcoin's case, the demand is potentially global and includes individuals, corporations, and potentially even nation-states. This combination of fixed supply and rising demand creates a powerful dynamic. The idea of stacking SATs, accumulating small amounts of Bitcoin, becomes particularly relevant in this context. Even small, consistent purchases can accumulate into a meaningful position if Bitcoin's value appreciates significantly due to increased adoption and its role as a global reserve asset. Armstrong's point is not a guarantee of future price, but a thought experiment based on a potential future scenario. If Bitcoin achieves even a fraction of the market capitalization currently held by gold or global reserve currencies, the value per Bitcoin would be exponentially higher than today. Therefore, owning 0.1 BTC is presented not just as an investment goal, but as a strategic position in anticipation of a potential shift in the global monetary hierarchy. It's about securing a piece of a scarce digital asset that could underpin future financial systems. This perspective encourages long-term thinking rather than short-term trading. It aligns with the view of Bitcoin as a generational asset, a form of digital property that could preserve wealth across decades, particularly in the face of ongoing fiat currency devaluation. Brian Armstrong's view is not isolated within the crypto exchange world. Key figures in the Bitcoin-native financial sector echo similar sentiments. The chief investment officer at Swan Bitcoin, a company focused on Bitcoin accumulation, provides further validation for the trend of institutional adoption. He observes that corporations are increasingly adding Bitcoin to their balance sheets. This isn't speculative trading activity. It's a strategic allocation of corporate treasury funds. Companies are holding Bitcoin as a long-term asset, viewing it as a hedge against inflation and a potential store of value in an uncertain economic climate. This trend is significant for finance professionals. It indicates a growing acceptance of Bitcoin within traditional corporate finance. Companies like MicroStrategy have pioneered this approach, demonstrating that it is possible to integrate Bitcoin into corporate treasury management strategies. The motivation for these corporations is often balance sheet diversification and protection against the declining purchasing power of fiat currencies. Holding cash reserves in a bank account yields minimal returns and is subject to inflation risk. Bitcoin offers a potential alternative with asymmetric upside potential. The fact that these corporations are not selling it is a critical observation. It suggests that these are conviction buys, intended for long-term holding periods, potentially measured in years or even decades. This reduces the available supply on exchanges, contributing to potential price appreciation. Data shows a significant increase in public company holdings of Bitcoin. A 30% growth in corporate Bitcoin holdings within a year, as mentioned, is a substantial shift. This demand from sophisticated institutional players absorbs supply that would otherwise be available on the market. For market analysts, this institutional accumulation is a powerful bullish signal. It represents sticky demand that is less likely to be influenced by short-term price volatility. As more corporations follow suit, the demand side of the Bitcoin market equation strengthens considerably. This trend also validates Bitcoin's maturation as an asset class. It is moving beyond retail speculation and becoming a legitimate component of institutional investment portfolios and corporate treasury strategies. This broadens the base of support for Bitcoin and increases its overall market stability. The actions of these institutional investors provide tangible evidence supporting the thesis that Bitcoin is evolving into a recognized store of value. Their long-term holding strategy reinforces the scarcity narrative and its potential impact on future price dynamics. The adoption of Bitcoin and blockchain technology is not limited to corporations and individuals. Governments and municipalities are also beginning to explore and implement these technologies, signaling a broader acceptance and integration into public finance and infrastructure. Examples like New York exploring Bitbonds demonstrate how cities are considering leveraging blockchain for municipal finance. While still in early stages, such initiatives indicate a willingness to experiment with distributed ledger technology for issuing and managing debt or other financial instruments. Beyond financial instruments, cities and governments are finding practical applications for blockchain. This includes using the technology for secure record-keeping, supply chain management, digital identity, and even managing public services. These use cases highlight the technological utility of blockchain beyond just cryptocurrency. The statement, "When one government moves, others follow," reflects a common pattern in the adoption of new technologies and policies. Once a government successfully implements a blockchain-based solution or explores integrating digital assets, it creates a blueprint and encourages others to investigate similar possibilities. This governmental interest, while often focused on the underlying blockchain technology, inevitably brings more attention and legitimacy to Bitcoin itself. As policymakers and public sector professionals become more familiar with the ecosystem, the path for broader digital asset integration becomes clearer. For tech enthusiasts, this governmental adoption showcases the versatility and potential impact of blockchain technology on public administration and infrastructure. It moves the technology from theoretical discussions to practical, real-world implementations that can improve efficiency and transparency. Economic analysts observe this trend as a potential precursor to national-level adoption or integration. While a nation-state adopting Bitcoin as a reserve asset is a significant step, municipal and governmental exploration lays the groundwork by building expertise and infrastructure within the public sector. The development of regulatory frameworks often follows technological adoption. As governments engage with blockchain and digital assets, they are compelled to develop clearer rules and guidelines. This regulatory clarity, while sometimes challenging, is ultimately necessary for mainstream institutional adoption. This governmental engagement, whether through exploring digital bonds or implementing blockchain for public services, signifies a growing recognition of the potential benefits of this technology. It adds another layer of validation to the ecosystem and suggests a future where digital assets play a more integrated role in the economy. Given the confluence of factors increasing institutional adoption, governmental exploration, and the macroeconomic backdrop of rising debt, analysts are revising their price targets for Bitcoin. While Tom Lee's $150,000 target is notable, Swan Bitcoin's CIO offers an even more ambitious outlook. He suggests that Bitcoin could potentially reach $225,000 or even $250,000. This isn't a random guess, it's a projection based on a specific market analysis model that considers supply and demand dynamics, as well as the impact of long-term holding behavior. The logic behind such a bold target is straightforward. More long-term holders combined with fewer sellers and rising demand creates a supply shock. Bitcoin's fixed supply means that as more coins are locked up in long-term storage or held by institutions unwilling to sell, the available supply on exchanges decreases. Meanwhile, demand continues to grow from various sources: retail investors, corporations, and potentially even sovereign wealth funds or central banks in the future. This imbalance between shrinking supply and increasing demand puts significant upward pressure on the price. Market analysts understand this dynamic well. It's a fundamental principle of economics. When demand outstrips supply, prices rise. In the case of Bitcoin, the supply side is uniquely constrained by its protocol, making it particularly susceptible to supply shocks as demand increases. We have seen the effects of supply shocks in previous Bitcoin market cycles. Events like the halving, which reduces the rate of new Bitcoin entering circulation, or periods of intense institutional buying, have historically led to rapid price appreciation as available supply dries up. The current environment, with increasing corporate and potentially governmental interest alongside persistent retail accumulation, sets the stage for another potential supply squeeze. The coins being acquired by long-term holders are effectively removed from the active trading market. For finance professionals, these price targets, while speculative, highlight the potential upside recognized by analysts focused on the digital asset space. They are based on quantifiable trends in adoption and supply dynamics, offering a framework for evaluating Bitcoin's potential future value. Understanding the mechanics of a Bitcoin supply shock is crucial for investors. It explains why even relatively small amounts of buying pressure can have a significant impact on price when the available supply is limited. This is a key difference between Bitcoin and assets with elastic supply. The question isn't just if the current economic trajectory is sustainable, but when and how the system might reach a tipping point. Brian Armstrong suggests this won't be a sudden, catastrophic collapse, but rather a gradual process that accelerates unexpectedly. He uses the analogy of a frog slowly boiling in a pot. The heat increases incrementally, and the frog doesn't react until it's too late. Similarly, the erosion of confidence in fiat currencies due to debt may feel slow and manageable until a critical threshold is crossed, leading to a rapid loss of trust. Historically, significant currency instability or crises have often occurred when a nation's debt-to-GDP ratio reaches critical levels. Armstrong points to the 150 to 200% range as a historical danger zone. The US is currently approaching this level, depending on how GDP is measured and projected. For economic analysts, this debt-to-GDP ratio is a key metric for assessing fiscal health and potential risk. High ratios indicate that a country's debt is large relative to its economic output, making it harder to service the debt and increasing the perceived risk of default or currency devaluation. If the US dollar were to lose its reserve status or experience significant devaluation, the question becomes, what replaces it? Armstrong dismisses the possibility of the Chinese yuan, noting that China also faces significant debt challenges within its own economy. This leaves limited alternatives among major national currencies that possess the necessary scale, stability, and trust required for a global reserve asset. This is where Bitcoin enters the conversation as a potential, albeit unconventional, candidate. Bitcoin's decentralized nature means it is not controlled by any single government or central bank. This makes it immune to the political pressures and fiscal mismanagement that can plague fiat currencies. For nations seeking an alternative free from geopolitical influence, this is a compelling feature. The tipping point might not be a single event, but a combination of factors: a loss of confidence in government bonds, accelerating inflation, or a geopolitical shift that encourages nations to diversify away from the dollar. Any of these could trigger a faster move towards alternatives. Understanding this potential tipping point is crucial for finance professionals managing global portfolios. It highlights the systemic risk inherent in the current fiat system and underscores the potential role of uncorrelated assets like Bitcoin in mitigating that risk. Brian Armstrong's bullish outlook on Bitcoin is intrinsically linked to Coinbase's broader vision for the future of finance. His perspective isn't solely about Bitcoin's price appreciation. It's about the fundamental improvements that crypto and blockchain technology can bring to the global financial system. He highlights the inefficiencies and limitations of traditional finance with pointed questions. Why shouldn't you earn 4.5% on your checking account? Refers to the low interest rates offered by traditional banks, contrasting with potential yields available in decentralized finance, DeFi, or through crypto lending platforms. Why can't you send money instantly, for free? Addresses the slow, expensive, and often cumbersome process of traditional money transfers, especially across borders. Blockchain technology enables near-instantaneous, low-cost transactions globally, bypassing traditional intermediaries. Why can't someone in Nigeria trade US equities 24/7? Points to the limited access and operating hours of traditional stock markets, which exclude billions of people from participating in global capital markets. Crypto platforms can offer 24/7 access to tokenized assets, democratizing investment opportunities. These aren't hypothetical scenarios, they are capabilities that the crypto ecosystem is actively building and, in some cases, already delivering. Coinbase, as a major crypto exchange and infrastructure provider, is at the forefront of developing these next-generation financial services. For tech enthusiasts, this vision represents the practical application of blockchain technology to solve real-world problems in finance. It's about building a more open, accessible, and efficient financial system powered by decentralized networks and digital assets. For finance professionals, this vision presents both a challenge and an opportunity. It challenges the existing business models of traditional financial institutions, but also offers new avenues for innovation, product development, and reaching underserved markets. Armstrong sees Bitcoin as the foundational layer for this new financial system, a secure, decentralized, and globally accessible store of value and medium of exchange. On top of this layer, platforms like Coinbase can build the applications and services that deliver these improved financial experiences. This long-term perspective on the utility and potential of crypto finance is what drives the development within companies like Coinbase. It's a vision of a more inclusive and efficient global economy, enabled by digital assets and blockchain technology. Let's synthesize these points and consider the implications. The macroeconomic environment, characterized by escalating global debt and potential currency instability, provides a compelling backdrop for alternative assets. Brian Armstrong's analysis from Coinbase underscores the potential for Bitcoin to fill a critical void if traditional currencies falter. While many people remain focused on short-term market fluctuations or are unaware of the scale of the US debt crisis, a growing number of sophisticated investors, corporations, and even governments are recognizing the fundamental shifts occurring. They are exploring and adopting Bitcoin and blockchain technology. The combination of Bitcoin's fixed supply, increasing institutional and governmental interest, and the potential for fiat currency devaluation creates a powerful narrative for long-term value appreciation. The concept of a supply shock driven by persistent demand is a real market dynamic. You don't need to allocate your entire portfolio to Bitcoin to acknowledge this trend. However, ignoring it completely might represent a significant missed opportunity or a failure to hedge against potential systemic risks in the traditional financial system. The analysis presented by figures like Brian Armstrong and the CIO of Swan Bitcoin suggests that the current price of Bitcoin, while volatile, may still represent an early entry point relative to its potential future role in the global economy. The scarcity is real, and the macro forces are aligning. At CryptoPulse, our goal is to provide you with the insights and analysis needed to navigate this complex and rapidly evolving landscape. We aim to decode the technical, economic, and market forces at play so you can make informed decisions. If this analysis resonated with you, if you believe understanding these macro trends is crucial for investing smarter, then smash the like button. Hit subscribe to join our community and ensure you don't miss future deep dives. Share this video with anyone in your network Crypto investors, tech enthusiasts, finance professionals, or economic analysts, who needs to be ahead of the next potential tipping point. This isn't just about tracking crypto prices. It's about understanding a potential paradigm shift in global finance. You are witnessing history in the making.